Good afternoon and welcome to our webinar. My name is Igor Zuckerman. I'm a CEO and Chief Investment Officer of Eureka Wealth Solutions. And we are here to talk today about impact investing after the pandemic. Before we begin, just a couple of quick housekeeping items. First of all, we have to make a statement that our compliance requires us to say, the disclaimer that we're talking about a number of different investment opportunities and investment securities. These are not personalized recommendations to buy or sell any securities. Some of them may also be part of client portfolios. You will find the full list of disclaimer at the end of this presentation on the last page. But just keep that in mind again, that this is for informational purposes only. Also, we'll be focusing on the domestic US markets, although conceptually it applies to other markets, and depending where you're joining from, just keep that in mind. Since I'm doing this presentation solo, I would like to make it as interactive as possible, which means questions are welcome. Any and all kinds of questions. You should be able to see a question mark on your screen in the top right corner. Feel free to type them in. I will probably leave the last 5 to 10 minutes for the questions, but if it's relevant to what we're talking about, I'll try to answer them as they come in. Finally, a copy of this presentation in a PDF format will be available at the conclusion for anybody to download. Just keep in mind, this is our copyrighted material. Feel free to download it. Please do not distribute it, especially commercially. So, with that said, let's talk about impact investing. So, what I would like to do today, what we should be talking about is, first of all, a little more background on impact investing. I'm sure most people who are joining today are familiar with the concept, but there's a lot of different notions of what impact investing should be and should not be that exist out there. I'd like to give you my take on it. We'll talk about different styles. What's available out there and how should investor look at it, and then of course we'll dive into specifically impact investing as it relates to 2020, the pandemic, and post-pandemic, and why should we even be discussing it today. So this is just a sample of recent headlines that you may have come across. These are literally on the past maybe 3 weeks or so. And if you look at them, and if you've, hopefully the reason you're joining this webinar today is because you've been following what's going on with impact investing. It's not a new subject by any means. In fact, some roots go back as far as the early 90s. But over the last couple of years, there's been almost an explosion of interest. So why is that? Well, there's a number of different things. First of all, there's an investor demand. And as any other economic product or service, demand drives supply. So as you can see, the little survey below that was taken actually in 2014, the younger generation, specifically millennials, are demanding investment options that will allow them to do impact investing. That's number one reason. The other important part is improved financial returns. So a sort of an investment myth has been around for a number of years, where if you want to do good, you have to sacrifice performance. And to some degree, in early in impact investing companies, it may have been true. If you look at early solar companies, for example, that have been hugely unprofitable, even with government subsidies, a lot of these companies went out of business and lost a lot of money for investors. And so the myth was sort of building on that. But as we'll talk about later on today, it's no longer the case. And in fact, there's a lot of case to be made that with the right tools, choosing impact investing can actually achieve better financial results than if ignoring them. A couple of other drivers: data availability. We'll talk about data a little bit later, but basically the metrics that would define what we would consider impact investing today were simply not available years ago. There's still a lot of issues with that data today, but at least the data, some of it is available and some of it is usable. New technology. Well, that's a loaded item, and that includes a number of different things, including various fintech companies, various research companies, ETFs that are now available, ability to trade on various platforms as sort of do-it-yourself. All of that contributes also to impact investing. And then finally, the supply of investment solutions. I just mentioned ETFs, but there are other investment solutions, including mutual funds, including closed-end funds, private equity, and many others that we'll also touch on a little later. So what is impact investing? I think most people have the sort of notion of what they consider it to be, but if you look at the definition, and here are the three definitions from Wikipedia, Investopedia, and the World Economic Forum, you can see that all of them are sort of similar and all of them are very vague. And I think there is a reason for that. There is no very strict definition of what impact investing is. All that you can say is that it's a style of investment that has the intention of generating a measurable, beneficial impact to either society or environment, and also it has a financial gain. So these are the only really attributes that you need to worry about. But they're important. So a benefit to society or environment, obviously, is a general notion that is not quantifiable here, but could potentially be quantified. Financial return can most definitely be quantified, and we just talked about the fact that this is not a charity, this is an investment style. So a financial return is expected by people who use it, and of course the measurable portion that's gonna come in handy a little bit later as well. So you may have heard some of these terms. It's the alphabet soup of impact investing. I'll briefly mention all of them, well, maybe some of them I'll spend a little more time on, but SRI, ESG, CSR, and SDG, what are these? Why should investor care, and how should you use it? So SRI stands for socially responsible investing. Basically, it's just integrating the social and environmental factors within the analysis that you would be already doing considering an investment. It's also sometimes referred to as values-based or ethical investing. And the way this is practically achieved is by producing what's known as a negative screen. So what you could do is, let's say, strike out certain industries such as alcohol or tobacco, gambling, weapons, and so forth as so-called sinful industries, if these are the ones that you as an investor or as a portfolio manager would like not to invest in. So CSR, and I'll just mention that also, this is a corporate social responsibility. Essentially, this is not really an investment principle, but this is an important concept to know about that is utilized by companies and by company management. It's a business model that will keep the company socially accountable, first of all, to itself and its stakeholders, but also to the public, and as well as clients. A number of different examples may include things like banking companies promoting community events, or even energy fossil fuel companies that make a high standard of cleaning up anything that may hurt the environment after they're done with their job. ESG, on the other hand, is another concept that I'm guessing most people here are familiar with. And ESG stands for environment, social, and governance. The three main columns of impact investing. In fact, it's the largest portion, I would say, of the impact investing today. And it's a set of standards that will focus on those three big areas. And the investors can use those to screen potential investments. And we'll look at that in a couple of minutes. And the difference between ESG and SRI screens is that ESG is in fact a positive screen. It's based on ESG data to determine whether or not you'd like to include a potential investment. Here is a quick look at what that difference means. So the negative screen means you start with an investment universe. Let's say start with the S&P 500 largest companies or all domestic US companies, whatever your universe is. And then you determine a set of negative criteria. What would you like to exclude? And then you remove it from that criteria. The positive one is you start with essentially an empty basket. So you start with the same S&P 500 companies, but initially, as opposed to the negative one, you have no companies that pass your criteria. You define the criteria, the positive criteria you'd like, and then you add the ones that pass it into your basket. So the approach is kind of the opposite way of getting to your universe. All right, I see no questions yet. So again, if you're just joining us or you join us late, there is a question mark icon at the right top of your screen. If you have any questions, please feel free to ask, and I'll address them most likely at the end of the session. But if there are questions before then that will be within the flow of what we're talking about, I'll try to address them as they come up. All right, moving on. So a couple of words on ESG data. So the ESG is the three big baskets that I mentioned, and there are a number of companies nowadays that collect the different data and provide and actually sell that data to index providers or to the companies building financial products or to just asset managers who would like to apply some of these principles directly to their investments. So these are just some of the examples. As you can see, I'm just going to mention a few things like carbon intensity, fossil fuel reserves, water sustainability, pollution prevention, green buildings, so LEED certification, LEED certification, you might have heard of that. Many of the new buildings, especially here in the New York area, are now LEED certified, specifically to be environmentally conscious. The social responsibility, that's probably even a bigger list, and it's obviously been in a lot of different headlines lately. It talks about a number of different issues, including things like UN principled values and values, religious values, human rights, nutrition, sanitation, and of course all the sinful industries that we just mentioned before, other practices such as predatory lending, and many others. And of course there's the inclusion issues, especially when it comes to clients, employees, and the management of companies. And that is the segue to the last one, the responsible governance. So a number of issues about the board. What is the board diversity? What is the independence? A number of issues came up in various companies where investors may not have ever looked at it or scarcely paid attention. But if you have a board that is primarily made up of the insiders who have been there for 10 years plus without a change, this is probably not the company that should be passing your ESG criteria, just because that means that the board may not always do the right thing, that they're too cozy at where they are. And this is just one of the examples. Of course, there are accounting flags, and if we could go back to the situations with Enron or MCI, even before that, for those who remember the giant accounting frauds in the past, an ESG criteria focusing on that could have possibly prevented people from investing in companies like that before they blew up. And executive compensation, again, another one on this list that has been in many headlines lately. Again, this is just a sample of some of these categories. And of course, some companies have as many as 200 different ESG categories that they're collecting data on. So how is ESG really used in investments? So as you can see, the left diagram shows you a little bit about it. So it's two parts of your investment analysis. In addition to your investment potential analysis, you would also look at the companies with high ESG sustainability scores. And those scores, I just want to be completely transparent, those are not standardized right now in any way. Typically, companies that do the analysis, or investment managers such as myself, or individual investors, would use probably a subset of those different categories that were on the previous slide and assign specific scores to them. A typical number would be between 1 and 100 to try to quantify it, and then measure that across other companies, its peers. And this way you could see a relative ESG high score would probably pass your criteria. And at the intersection right here in the middle of that diagram on the left, that would be a sweet spot where you would be looking to invest. The right graph shows you an interesting study from TD Ameritrade that talks about what investors said is the most important aspect for them while choosing impact investing. And as you can see, rate of return adjusts slightly higher than everything else. Again, this is an investment as opposed to charity, so return is important, but so are other factors such as social impact, the goals of the companies that are involved in your investment decision, environmental impact, of course, as well as some other goals. A number of issues still exist today with ESG, and the problem is bespoke categories. Some categories exist with some data providers and not the others. Some exist within certain industry group and not with the others. Data is also missing or unavailable in many cases. So just to give you an idea, for example, for a company that is involved in commerce, one of the common metrics is number of customer complaints and how many of them have been successfully resolved. That would be a fantastic point for any ESG investor, or for that matter, for any investor period, because it's directly correlated with company's performance. Unfortunately, that type of data is very difficult to come by. Companies are not required to report it, and therefore, and they know that it may be damaging to them, and therefore, that data is hard to come by. Multiple data providers, again, you could sometimes see a conflict, and there is usually no good way to really verify whose data is better. Of course, there's no standard access to data, as opposed to, let's say, financial data, which is required and free. Anybody can find it with government filings. There's no standard access to this data. Usually you would have to buy it, and for an individual investor, that's usually not an option. It's prohibitively expensive. Of course, there is also no reliable audit, as opposed to, let's say, financial data. And the scoring system and methodology, as I said, it's emerging, but it's not set. And of course, there is no regulation. I may add to that a number of steps have been taken lately for the regulatory requirement. And in fact, Europe is ahead of the US in that aspect. But there is hope that within the next 2 to 5 years, there will be some regulatory framework around at least a minimum of reporting requirements and perhaps some sort of methodology. The last thought to leave you on that is just a comparison between two leading data providers. The correlation between credit ratings, for example, for companies is about 90%, where ESG ratings it's 32, meaning they're really far apart. So a couple of ESG selection examples. This is more meant for you to think about in terms of your own personal criteria of what investments you are comfortable and not comfortable investing in, and what your exclusion and inclusion criteria may or may not be. Just a few ideas. So British Petroleum, that sounds like a pretty easy choice. You would say, well, it's a fossil fuel company, and in fact, about 10 years ago, they had a major oil spill in the Mexican Gulf. We have a number of investors now, a number of clients of Eureka Wealth Solutions who wouldn't touch fossil fuel companies no matter what, just exclude by definition. One thing to think about, though, is that for a number of years now, they've been aggressively developing renewable energy sources. Does that mean that they should be included in your criteria after all? I'll leave that question up to you. Nuclear energy, again, I'll just run through these. So it's a low carbon energy, but on the other hand, has a nuclear waste, and there's a probability of meltdown. Low, but don't tell people from Chernobyl about that. Wind power, again, that seems like a no-brainer. Obviously, it's one of the main renewable energy sources. However, did you know that it's also a major cause of death in birds globally today? Again, does that pass your criteria? Lithium cobalt miners, so I'll let you take a look at all of these. Facebook, again, just about a year or two ago, we had all these issues of privacy controls and issues handling. And in fact, some of the most prominent impact investing funds dropped them quite publicly from their funds. Again, it's your call. You're the investor. IBM, okay, this is really a little bit out of the left field, but anecdotally, a friend of mine who's also an advisor told me a story that he had a client who is a gentleman, an older Jewish gentleman, who basically said there is no chance he will invest in IBM because in World War II, there was an instance of IBM collaboration with the Nazis in the late 30s. So again, does that ban you from investing into IBM today? It's your call. I won't judge. Okay, so just to finish with the alphabet soup, let me just run quickly through this. SDG. What is that? This is Sustainable Development Goals. This is the principles, 17 principles that were adopted by the United Nations member states. They were developed, or I should say championed originally by Kofi Annan, the late Kofi Annan, the UN General Secretary, around 2000, and in 2015, finally, every United Nations member state has passed that as a principle with the goal of making some achievable and measurable progress by 2030. These are the 17 goals. You can see them below. And in fact, there was an ETF focused on these 17 goals specifically, as opposed to any other style of impact investing. And the ticker symbol here, you can see it SDG, same ticker symbol. That was issued almost 2 years ago now. This is just another view of SDG, where you can break it down into sort of 5 themes: basic needs, empowerment, climate change, natural capital, and governance, but the same 17 principles that were on the previous slide. One more thing to say about impact investing. It's not just equities. So obviously that's what we've been talking about for the most part. ESG, thematic, and we'll touch on thematic in a minute. Shareholder activism. This is also just a brief mention that on that. Sometimes we're asked why we have a portfolio, let's say, of smoking companies if we focus on ESG. And the answer is, well, first of all, there may be other reasons why people want to invest in it, like, for example, for dividend, and we are not, again, judging. It depends on your values as an investor. But the other reason is shareholder activism. There is a movement of investing into companies where you can fight for ESG principles from within. In fact, there is a number of larger institutional investors and hedge funds that are doing this right now, taking up larger positions and having a bigger voice within those companies, bringing up those issues and, like I said, changing the companies from within. So keep that in mind also. But in addition to that, you have fixed income. So there's green bonds, for example, bonds based on the assets that are environmentally friendly. And there is actually quite a few of them already. And there's a number, there's one prominent ETF that deals with green bonds already, and there are several that include them as well. There is, of course, real assets, such as green real estate. This is what I mentioned before. This is LEED certified buildings. There's sustainable agriculture and renewable energy, obviously. But also you have alternatives in hedge funds and in credit. And in private equity, where you have seed capital and venture capital investing aggressively, especially over the last couple of years, in new startups, essentially, and smaller companies that are involved with ESG investing. So this is sort of your quick checklist if you want to invest in impact. This is what you need to do. Decide on your value criteria for inclusion, exclusion, and importance. So what that means is, what would you like to see in your portfolio, what you absolutely do not want to see in your portfolio, and importance in terms of weights. Is it which factors are more important if you are including them? And then, of course, you prioritize it with other investment criteria, which is the sort of mainstream investing analysis. And then, of course, this is also an important step. There's so many funds and so many investment vehicles now, especially over the last couple of years, with ESG or impact investing labels. You really need to make sure that whatever your values are in fact compatible with what the values or the selection criteria of your fund manager or advisor are. And this is on the bottom, you can see the line of where impact investing really stands. So on the left, you have philanthropy. Essentially, you are not expecting any financial return. You just want to do good. Then you would have the ESG that we talked about. Then more to the right is SRI. This is the negative screen. And then the thematic investing. So thematic investing, we'll talk about it in a moment. This is investing based on different themes, and a lot of them can be within ESG or SRI. And then, of course, all the way to the right, this is mainstream investing. This is basically the only consideration is potential profit. So those three spots in the middle, those are your impact investing. This is the impact investing universe. So just briefly, let me talk about investing themes. So our company specializes in thematic investing and impact investing. And a theme is really a trend. And it could be a trend in a number of different things, in the economics, in demographic, geopolitics, regulatory, or most likely the innovation trend, technological factor. The idea is that if you're able to recognize what a new trend is and identify investment opportunities in it and get in when it's still early, you may be able to get a significant market outperformance. This is also not a new idea. It's been around actually for decades, but traditionally it's been within the realm of institutional investors. And now, over the past 10 years or so, I would say, there's been an explosion of fintech as well as niche ETFs that have been addressing various themes in the market. Basically, we also can do this at a fraction of the cost of what used to be at institutional investments, where we spot those, we build the portfolios, and we allow our investors to invest in their values and passions using this approach. So how can you as an individual investor spot them? I'll give you a quick 2 tips on how you can do it. One is watch the IPOs. So IPOs, the initial public offerings, tends to be selling the startup. When the startup sells their initial shares to the public, the insiders try to do this at the most opportune time. Basically, when the markets are good and when whatever the company is into is really, hot, basically, for lack of a better word. So watching the trends in IPOs can give you an idea of what is the hottest new trend in the market. And the second one is watch the new ETF launches. Kind of the same idea, especially when it comes to thematic ETFs. They tend to be relatively small, niche, and frankly, the economics for an ETF to stay profitable for the company that launches them, they need to be able to gather enough steam, enough interest, and enough assets under management to stay alive. And so again, those ETFs will launch when there is demand. So here are some of the theme examples. The names in the blue are the actual ETF tickers. And again, I'm reminding you that none of these are recommendations, personalized recommendations to buy or sell. This is for informational purposes only. But as you look through these, let me just give you a quick story. So if you go all the way back to the 90s, perhaps the biggest technological advance, and maybe not just of the 90s, but of the second half of the 20th century, was the invention of the internet. And if you were able to get into the ETF that was built back then, that included about 30 stocks, you would have had about a basket of 25 bankrupt companies a few years later, maybe a couple more that were sold at maybe some profit, but not a lot. And then there's 3 or 4 companies that were left that have made, thousands of percentage points for investors, in some cases tens of thousands, since the investment. I'm talking about the winners of the 90s internet, companies like Amazon and eBay and Match.com and Yahoo and so forth. And so, long story short, this is the point that I'm trying to make. If you're able to recognize this early and you buy the entire basket as opposed to try to pick winners and losers and hold them for a long time, well, if you did that, you probably wouldn't be listening to me right now. You'd probably be kicking back on some nice white sand beach somewhere. But that's the idea that thematic investing and specifically ESG and impact investing as portion of it is all about. So this is technological, geopolitical, and economic, and then obviously some other themes that you can see here, including social trends and demographic trends, and regulatory and legislative trends as well. Perhaps some of those may not be as appealing or as sexy, but they're definitely trends that can be invested in and be profitable. So, putting it all together from what I said before, these are your 2020 thematic ETFs. Keep in mind, these are new ETFs that were just issued this year. Not all the ETFs that were issued this year, these are within themes. And as you can see, most of them fall within either impact investing or a technological innovation trend. But you can sort of get the idea of how many broad ESG ETFs are being issued, as well as if you look at the specific themes that are in the innovation space, you can see artificial intelligence repeated several times. You can see gaming and sports betting, as well as e-commerce and several biotech ETFs. And that's what you really need to know about the trends so far this year. This is the list of the individual stocks. This is what's been working in terms of investments so far this year. These are top 40 best performing stocks in US with a minimum of 300 million in market cap, which is just removing sort of the very, very small companies that may have done better but may not be indicative of what's been going on. And again, if you look at it, the very top of it is all biotechnology. These are companies chasing the COVID-19 vaccine or cure. And if you haven't heard of some of them, believe me, 6 months ago, no one's heard about these companies, and even now, only a few people do. Other than that, if you see the other winners, you see a lot of companies in the software space, specifically in the software as a service, known as SaaS. Also, a lot of companies in e-commerce, and of course, a number of electric vehicles. So we'll talk about that in a second, what that is all about. But these are your top 40. And this is what worked in ETFs so far this year. And this excludes, I should say, any leveraged ETFs, because they're not really relevant to long-term investments, and no VIX or any other volatility types of ETFs. So if you look at these 29 ETFs have done 50% or better on the year. And as you can see, the ARC family of actively managed in ETFs that focus on innovation, they really dominate. So this, again, will give you an idea of what's been working so far this year. And what I want to look at right now is by theme, exactly what has been working. And keep in mind, so these three groups of themes, some of them are new, but majority of them are not really new. These are trends that have just been accelerated by the COVID-19 pandemic. So if you look at the entire stay-at-home large theme, all these things like e-commerce and delivery, cloud software, collaboration and communication tools. Whoever heard of Zoom company 6 months ago, and now it's almost a verb, just like Google once became a verb. It's so common now, especially in the US. Online education, digital gaming, esports, streaming entertainment, cybersecurity that goes with it, and semiconductors that are used for all of these. So these are all sort of known different themes that if you paid attention to the market, you know that they've been doing really well. In medical technology, again, so anything that's developing a vaccine or cure, diagnostic tools and facilities, protective gear and medical research labs, all of those have been a focus and have been working as investments this year. And then the green energy and transportation. Perhaps part of it was the crash of the oil economy when the traditional economy, manufacturing and transportation essentially came to a screeching halt back in April. And this, again, is a hugely accelerating trend. Solar and wind power and other alternatives, energy storage and batteries development, and electric vehicles. There have been several new IPOs, both in US and China, and Tesla stock has gone on a tear as well. If you were paying attention, they're up more than 300% on the year. So what we have done in addition to these is that we've gone beyond that. Back in March, the end of March, we looked at the secondary themes, meaning themes that were emerging based on what the new economy and the new world we believe is going to look like once we are, well, as we're living with the pandemic and as we're hoping to emerge from it. And we were able to build some of those portfolios and have our clients take advantage of them. So I'm going to reveal some of those themes. What it comes down to is essentially any trend, as you know, whether it's an investment or anywhere else. The question always is, if you initially, when you're recognizing it, is it going to be sustainable, or is it just a fad? And once it becomes a bigger trend, the question is what's going to disrupt that trend? Is it going to go away eventually? If things will change, or is this, again, sustainable for a longer period of time and is still worth investing? As many advisors or asset managers say, the easy money has been made. Of course, it's a 2020 kind of statement, and by that I don't mean this year. I mean the hindsight is always 2020. It's always easier to say now, yeah, you should have invested in Zoom and Tesla. Well, wasn't that obvious back in March. But again, the question now is what's next? I'll take a quick minute to give you a little story that may help you understand where I'm coming from. In 1980, in New York City, there was a big strike. It was the transit workers went on strike at the beginning of April, and for 11 days, the city of New York was without transportation. And keep in mind, this is 1980. There is no Uber or Lyft, and there is obviously no telecommuting as is. So people need to get to work, millions of people every morning. So what did people do? Believe it or not, before 1980, people did not cross Brooklyn Bridge on foot. Just wasn't done. Nowadays, tens of thousands of people do it, and it started back then. Another thing is women specifically who came to the office would always come in shoes. Nowadays, if you're in New York or perhaps in other larger cities, it's common for women to wear, sneakers or other type of shoes before having the dressed-up shoes in the office. Believe it or not, before 1980, that wasn't a standard practice. In fact, nobody did this. And it started back then, April of 1980. So my point is very simple. This was a localized event that lasted 11 days 40 years ago. And at least a couple of social trends started back then and never went back. So now we're dealing with a global pandemic that's changing our lives in many, many different ways. So clearly, if you think that some of these trends are going to go away, maybe they will, but keep in mind, some of these trends, especially social trends, may not go back ever. So with that story, let me just quickly run through some of these new themes. And perhaps some of them have already been discussed, but I'm just giving you the overall idea. So I'm going to stop, since we're running out of time, I'm going to stop just on a couple of them quickly. Robotics, artificial intelligence, smart home, Internet of Things, LED. So one of the things that people forget about, for example, is that all these new devices that they need at home for work and for school and for entertainment, this is all LED displays. That is a secondary sort of a derivative theme among other themes. I'm not going to spend too much time on this. So drones, they're being used more and more by the industrial companies to check on construction, to check on installations. This is only going to increase another accelerating trend. So here's just some of those themes. And this is our top theme. It has been for a while. Again, it's accelerating. This is really an umbrella of themes, smart cities. And these are all the different things that go into it. We believe that a combination of these items, as our urban development is changing also due to COVID-19, this is where a lot of money is waiting to be made. Just a couple of words about us, Eureka Wealth Solutions. So we're a fiduciary. We do traditional full service as well as digital. And of course, we're all about your values and passions. We specialize in thematic and impact investing, as I mentioned, with over 400 different teams, with about 40% of them in impact. We also donate 2% of your fees to us, to a charity of your choice, which is, I believe, is unique in the industry. But we believe that's the right thing to do. And if you go to our website, this is what our model allocation process would look like. So you can see if you answer a couple of quick questions and choose some of the investment areas that are attractive to you, you would see what your portfolio would look like and how it would have done versus stocks and bonds over different periods of time. A couple of words about me. I am, again, Igor Zuckerman, co-founder, CEO, and Chief Investment Officer. I've been in the industry for over 25 years, working for some of the largest banks. And this is what my passion is. This is what I do for a living since 2014. My email is also here. Feel free to email me if we run out of time. And this is the disclaimer that I've been promising you before. So we just have a few minutes left. Are there any questions that I can answer? Please, again, go back to the question mark and feel free to type it in. So the one question I have right now, I'm just going to read it. What are the methods and solutions to increase investment in families during a pandemic? I'm not sure I fully understand the question, but if we are talking about help through either government programs, that's not really within the discussion that we're having right now. If we're talking about sort of investing in yourself as something like online education, there are definitely a lot of tools out there that can help you hopefully get a job that you need, or learn a new skill that wasn't available before, that maybe in today's gig economy is going to be helpful. Of course, there are some principles back in SDG that may there are some specific investments that deal with that situation. I'm just going to jump to this slide for a second. So this is this empowerment portion where you have quality education, gender equality, industry innovation infrastructure. So there are companies globally that are investing into this sector that you can benefit from as well. I hope I'm addressing your question. If not, please feel free to let me know or specify exactly what else you may mean. And I'm happy to answer any other questions. We'll just have a couple of minutes here. Just going back to the slide with what's next, some of the themes that I encourage investors to look at as potentially investments for the age of the pandemic, and all of them would also fall into the realm of ESG and impact investing, depending obviously on your specific criteria. All right, if there are no other questions, I will end the call. I want to thank all of you for joining us today. Again, if you have any more questions, please feel free to email me. I'm going to put up this slide again with my information. Feel free to check us out. There's the website is the link to the website, as well as this entire presentation in PDF will be attached to the on the website with this webinar. And with that, thank you very much, and have a nice day.